What does it look like when two leaders, each defined by experience, innovation, and performance, unite to elevate Canadian real estate lending? With nearly a decade of serving the needs of investors, borrowers, and mortgage brokers in the alternative market, Neighbourhood Holdings has now taken a major step forward by acquiring Fisgard Asset Management, forming one of the largest alternative mortgage lenders in Canada. Together, they manage nearly $800 million in mortgages across more than 2,000 borrowers and over 3,000 investors nationwide. Through the Neighbourhood banner, the team works directly with mortgage brokers across Canada, providing short-term mortgages for quality borrowers who may not fit traditional bank criteria. Every loan is backed by real assets, ensuring a measured, conservative approach, seeking to provide investors with stable income while preserving invested capital. Whether you're a mortgage broker seeking flexible financing options or an advisor looking for regular income solutions, Neighbourhood's expanded reach brings track record, transparency, and opportunity, now even stronger with Fisgard's 30-year legacy. To learn more about the Neighbourhood, visit neighborhood.com to view the offering memorandum or speak to your financial advisor today. This is not advice, and consult a professional advisor before investing a loonie in any of these investments. Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble.
Welcome back to the Loonie Hour, episode 220. As always, joined with the three amigos. We got Boomer over in Halifax, Rich Diaz, Montreal. What's going on, Richard?
What's up? How's it going? I'm a little stressed because I have all this Christmas shopping that I, of course, left to the last minute. But otherwise, I'm good. Nothing to report. Oh, I have a good story. I was Santa Claus. I shouldn't say that. I guess they probably don't listen. My friend of mine had a Christmas party and there was about 20 kids and I was voluntold to be Santa Claus. Maybe we can show the picture. That would be funny. And it was really fun. I was actually really kind of stressed and terrified. I really didn't want to destroy childhood memory for 15 very young kids, but some of them were terrified. Only one of them burst out into tears and started wailing, which is fun, very cute and very funny. But yeah, so we handed out some gifts. A couple of them sat on my lap. I'm certain one of them gave me the lurgy, and I'm sick now as a function of that. But it was really fun. It was a good Christmas party. There you go.
Seen that episode of The Office where there's two Santas? Phyllis dresses up as Santa.
No.
It's one of the best. Anyways, Keith, what's going on, buddy?
Oh boy, hey, it's my favorite time of year. We're all wearing the hats today, by the way. So if you're not watching, Steve, you are not wearing a Christmas hat. It seems like.
Don't know where it is. Can't find it.
Steve is wearing a Buffalo Bills football toque.
It's hot. This thing is really hot. I'm sweating already.
As everyone knows, Steve has been a lifelong Buffalo Bills fan since 3 weeks ago.
Yep, go Bills, baby. You guys ever looking for a good vacation spot? I'll give you the details of my Airbnb in Buffalo.
Oh dear.
Okay,
Buffalo, Keith, did you know in Buffalo, the number one beer is Labatt Blue?
Is it? Why?
It's so bad, Canadians don't even drink that stuff. And there's a Tim Hortons on every street corner. It's insane.
Yeah.
From a legal perspective, by the way, taste is subjective. It's not a fact.
What?
I will say this.
You just mullered Labatt's Blue, so let's be a bit...
Labatt Blue?
Yeah.
I think there's an S. Anyway.
Oh, man, I sure hope anyone that listens to this pod, I sure hope you don't drink that. That is
that's not good.
Hey, I'm going to liven things up a bit here.
Go for it.
In the Christmas mood.
I'm ready.
Okay, you ready? This is it's a Loonie Hour Christmas song. I'm gonna. Steve is very excited.
Skip fast forward now.
Here we go. Dashing through the snow on a rate hike housing play, listings start to slow as buyers walk away. Rich.
Ho, ho, ho.
Oh, for God's sakes. Hey! Let's start again.
Okay.
Dashing through the snow on a rate-hiked housing play, listings start to slow as buyers walk away.
Hey.
Steve says, I've warned you all. Diffusion index down. Affordability's broken in every single town. Oh, rate hikes, yield curves tight. BOC is still hard to read. Rich says demand is still strong, assuming rates concede. Boomer laughs, you'll all be fine. I've been much worse than this. Ben Rabidoux drops chart and calmly says, yeah, recession risk. That's it.
Amazing. That was amazing.
Thanks, man.
That was actually
Lost
really
our, we just lost at least 5 subscribers there.
Yeah, that
wait.
was well done.
I have 18 more verses. CBC says.
Oh,
Anyway.
Light us up today. What are we doing today besides losing half the audience?
We've got Ben Rabidoux, a friend of the show, coming on to join us in the later half here to really just talk about markets. And ultimately, we're all going to give one sort of forecast or prediction for the year ahead. So it'll be sort of a good discussion. Again, this is being recording on Tuesday. We usually record on Thursdays, but we're recording on Tuesday, December 23rd. It will be released, of course, on Friday, Boxing Day. So, and then we will be recording next week, I think on the 31st, and that'll drop, I guess, on 1st or the 2nd. Anyways, so yeah, we still got a whole bunch of guests lined up, but this week we'll do the sort of forecast stuff, but just sort of a little preamble here, Keith, just a little bit on the news stuff. So we had an update in the Toronto housing sales figures. So Build Canada notes that there was 165 new condos sold in the entire GTA last month. And it says new home sales will finish the year at their lowest totals ever since data started being collected in 1981. So for the entire calendar year 2025, it'll be the fewest home sales since at least 1981 in the GTA. And I think that the important thing here is that there was 165 new condos sold in the GTA last month in November. But when you actually unpack that a little bit further, so again, 165 condo sales in a metropolitan area of 4 or 5 million people. Just because those 165 units sold, a lot of them will actually ultimately be getting canceled because if you're a developer and you launch your building, right? And let's say you have a 200 unit building, but you only sell 15 units, well, then you're not hitting your pre-sale financing requirements. And thus you will then cancel that project, 6 months, 12 months, 18 months from now. So the reality is if you looked at 165, that could end up being 25, right? when all is said and done. So effectively, it's really interesting because I think we're running into a scenario when you have the fewest home sales going on record. Where are pre-sale, where are new condo completions 3 years from now, 4 years from now? Because I don't think anything is actually getting built when you have this few sales.
Didn't we have 25 sales the month before this one?
I think that 25 was just for the city of Toronto. This is 165 for the entire GTA region.
Just to put into context, what was the peak in 2021 and 2022? And then what was the 20-year run rate? What's a normal number that we're supposed to be thinking about or looking at?
Let's see. We are something like 90% below the long-term average.
Loonie Hour math. I'm going to put at around 1,300.
Yikes.
I can tell you right now. So if you look at current month sales, new home sales for all product types, the 10-year average is 2142 for November. So 2100, call it. And we are at 165.
Yikes.
So here's a good one. Here's year-to-date sales. So the 10-year average for year-to-date GTA condos, not single-family or townhouses, just condos. The 10-year average year-to-date is around 18,000, so 18,600. We're currently at 1,900.
Yikes.
So the good news is that there's only 1,900 to go before it reaches bottom.
And so in 2021, which is obviously like the peak of the bull market, it was like just under 30,000.
And by the way, everyone, Steve just referenced the peak of the market in 21. What was the 10-year at that point, Rich?
I don't know.
1%.
Very
1%,
low. Yeah, 1%.
basically.
Very, very low.
Yeah. It follows that whole narrative that we've been sharing with everyone that as long as long-term rates keep going lower and lower, it's good for everyone, but they can't go much below 1. I mean, that is basically the floor. And then it went from, I think in the US, the 10-year went from 1% to 4%. Then in 22, like that. In 22. So, I
mean, go ahead. Sorry. Go ahead.
Well, here's the best part. So obviously that development industry, when you go from 30,000 condos a year pre-selling to call it, 2,000, you have a problem. And so the government, of course, is now looking at this. And there was an article yesterday written in Bloomberg, and there's been a lot of there's been a lot of leakage over the last sort of 6 to 12 months in terms of what might get done. But Bloomberg reported that Canada is considering changes to its ban on foreign home buyers starting in 2027, per Housing Minister Gregor Robertson, who, again, former mayor of Vancouver here. So he goes on to basically say, quote, "We need to make sure housing is built and owned for Canadians first. However, that said, we've seen more innovation on this in countries like Australia that enables some foreign investment into higher end new homes, or in some cases, rental housing." And in which I actually clipped at a speech that was given from Bob Rennie, who's sort of the condo king here in Vancouver, who's very well connected politically. He actually notes in that interview that he's been discussing and chatting with Carney, which is basically they're looking at creative ways to bring in offshore capital, outside investment dollars to basically someone's got to buy these overpriced pre-sales, and it's not going to be the local pitch.
Okay, wait. I have a question. A part of this, I feel like, is there's this one little wrinkle that I think bugs me about this. Like, if you're a foreign investor, you can still buy REITs, real estate investment trusts, can't you? And you can still buy shares of companies that develop in Canada. So right?
Sure.
There's no restriction to buying.
Right. So that's my point. So the idea that foreign investors can't participate in our real estate market right now just rings a little bit hollow. I think is he really?
I mean, I see both sides. I mean, I don't know. I struggled. I know like the financial markets like to look at and say, well, why don't you just buy a REIT? I don't really think they're the same thing, truthfully, but I hear that a lot. I mean,
I agree with the Buffalo Bills guy there on the screen on this one.
So, okay. So I see both sides. First of all, I think it's kind of ridiculous. I think politically it's incredibly unpopular to allow this, but I think it's highly likely that they will in 2027, because that's when that federal foreign buyer ban expires. So it expires, right? So you can just quietly not renew it. And it sort of gets swept under the rug, and you can make some adjustments there, right? So basically the idea is listen, and the reality is, Keith, you'll appreciate this. If you need to build any of these high-rise towers, it requires investors, it requires capital. And so if you're going to build a record amount of new housing, you need capital. Now, again, the argument is that the capital base domestically is not deep enough. And so they're going to go offshore. Now, I think if you look at Australia's housing market, it's actually worse than Canada's. You know why?
I'm so confused here right now. So I'm so confused with this, because on one hand, we're saying that the Canadian, call it the condo apartment rental space, is already a glut of supply out there.
Yeah.
Yeah.
The last thing we need is actually more money going in to create more supply. We will in a couple of years. But we don't need, and the second part of this, you say, how do we get into this challenge in the first place? It's because, the provinces in Ottawa got involved. They're trying to make housing more affordable and all that stuff. And they didn't do any of that. So I don't think they should be, if you're trying to encourage foreign investment to come in, that means that government is going to subsidize them. in some way. Instead, you just have to make the market strong enough so that it will come automatically. And I think what Ben shared with everyone at the Toronto event we did, I think it's a 2-year
2-year ban
period. Yeah, a 2-year sort of runway we have to go through. So, Steve, when you're speaking with those guys out there in Vancouver, and Rennie, I don't know the gentleman's first name.
Bob.
Yes. Say, no, don't encourage the government to do anything to attract.
I mean, I think there's just
investment.
I mean, I think they just got to leave it, truthfully. But I mean,
yeah,
I think that market's so bad. They're obviously looking and saying, listen, like this thing is basically dead. It's not even on life support, and we got to do something. And so, like, obviously, you know, if you have the development industry lobbying. And we've seen a lot of them. They've been lobbying, you know, the federal government to say remove the foreign buyer ban. You know, every large major developer has been, you know, penning an article. So yeah, I mean, if you look at Australia's market, just for context, what they allow foreigners to do, and obviously it's a lot of Chinese money, is they're not allowed to buy any resale product. So you can't go buy a house or a 10-year-old, 12-year-old condo, but you can buy what they call off the plan, or basically pre-sale condos. So you can go in and basically, you know, they're allowed. Basically, the idea is like, well, they're not buying existing stuff and competing with local Aussies. They're buying developer units that, you know, need this capital to get off the ground. So that's argument.
BS, because it's raised the floor. I mean, housing is super expensive in Australia.
I would argue it definitely, like, yeah, it's tough. I kind of see both arguments, but I mean, truthfully, I think there's no appetite whatsoever.
I mean, the Australia thing is just like the parallels with Canada are very obvious. Remember, I mentioned Demographia, that website last week. Go check that out. You could see Sydney and Brisbane and Adelaide, and Melbourne are all very, very high median household price to median household income. And take a wild guess why there's been so much upward pressure on prices is because they've massively increased population growth. Again, I go on and on about this, but I have the annual net immigration statistics right here, right in front of me. From 1945 to 2007, it was 90,000. And then from 2008 to 2019, they increased it 228. So that's more than almost 3x or 2.5x or whatever. And then from 2023, average net overseas migration was 424,000 people. So it doesn't matter if you have foreign investors or you relax zoning. It's crazy. I mean, they just basically open the floodgates and then they wonder why housing is so expensive. I mean, it's just ridiculous. Obviously.
I follow a lot of those Aussie economist accounts on Twitter.
Yeah.
And they literally write about the exact same thing. It's like,
I know.
There's too much immigration. We had this crazy boom in the pandemic. You know, house prices are up, rents are up. It's the same. It's literally, it's like Canada copy paste
with better weather.
Right. And yes.
And shittier at hockey, I'd say probably.
Kind of interesting. I was in New York there a few months back, and we were meeting with a very large Australian financial entity. And so I went through this pitch book showing them that all the problems in Australia from an economic financial perspective, they're also the exact same thing is happening here in Canada. And they had no idea. This team that we're speaking with, they just thought they had their own domestic problems and that was it. And they were very unique. So, from a financial perspective, one way to hedge Australia's problems is to short the Canadian market. And then vice versa. Because, you're not allowed to short your domestic market if you're one of these big, large funds. It's just not, politically acceptable. But it's all about this sort of, this synchronized risk that we've talked about as well.
Anyways, we'll get into a little bit further, but we got friend of the show. I think he's been on 3 or 4 times now, Ben Rabidoux.
The very anxious Ben Rabidoux, by the way. He's in the weight room and he's losing.
I think that's who called me.
In your incredible macro credit housing analyst, writes private research for institutions, hedge funds. Also has a piece called Edge Analytics, which is basically a lot of the same sort of research written for the real estate industry. So if you're interested in that, if you're a realtor, mortgage broker, etc., edgeanalytics.ca. There'll be a link in the show notes. But without further ado, let's bring Ben in here now. Ben, welcome back to the Loonie Hour.
Hey, good to see you guys. Merry Christmas.
What is this, like fourth time?
Yeah, it's at least 3. I think it might be 4.
Getting sick of you already, to be honest.
Yeah.
But
I don't blame you.
And still no microphone.
Yeah, what the hell, guys?
So your Christmas headgear, you look something like Buddy from the movie Elf. Remember? Santa, it's me, Buddy.
Oh, yeah.
Will Ferrell.
Will Ferrell. It's a great movie.
Great movie.
Yeah. Steve doesn't watch those kind of movies because they make you feel good. Steve likes the ball
grumpy movie.
Yeah, but when his kid gets older, he'll get into those ones. Those are great Christmas time movies.
Just the host trying to keep you idiots in line here. So.
At the same time, it is not Christmas until Hans Gruber falls from the Nakatomi building.
Correct.
Thank you, Keith.
Yeah,
Correct.
Macroeconomics. Okay, let's go, Steve. Get us in line here.
Yeah, we got a few things here. I just wanted to briefly chat because I know Ben's pretty dialed on the macro stuff, so perhaps you and Rich can debate it. But there was an interesting GDP revision out. Was it this week? Where
a couple weeks ago.
Yeah, showing Canada's GDP. So, Rich, you've had that great chart, which is like, I think Ben was actually the original. I don't know. Anyways, GDP per capita over the last 10 years has effectively been like flat. And so, of course, there's been some GDP revisions. There's been some population declines, and now it's showing like a marginal uptick. So there's kind of like a debate going online saying, well, turns out it wasn't a lost decade. Look at the GDP revisions. GDP per capita actually grew marginally. I don't know if you have any, brief commentary on that.
You want me to kick it off, Rich, or you want to jump in?
You go for it. You're the guest.
Yeah. Okay. Well, look, I think you highlighted it perfectly. You used the word marginally, right? Yeah, it's up marginally. So we've gone from it being terrible to just being kind of a dog shit decade. So, like, if you want to run a victory lap on that, like, by all means, there's just no getting around it. This is still, like, we have lagged U.S. GDP per capita GDP growth horribly, and we've lagged most countries in the OECD, even accounting for these revisions. So, like, I mean, okay, if you want to dunk on people who are over Trudeau's legacy for that, like, by all means, but this is not a great print by any means.
I mean, I think that the real issue is that it's funny how the arc, I think, is very important to contextualize it. To contextualize the arc is important, which is we went from, oh my God, this number is bad. And then out of the woodwork, there was all these people disparaging GDP per capita, saying it's not a good measure of data. Remember that, Ben?
Yeah.
By the way,
I do.
just so you know, all economists are
Rich got in trouble for that quite a bit.
But like, my point is that all people understand that GDP per capita is a flawed and imperfect and very blunt tool for assessing standard of living. Nobody in our business makes the mistake that that's perfect. But the joke really is that for 3 years, they spent a lot of time and a lot of ink, frankly, arguing that it was not a good measure. Now that it's been revised by 1.8% over the last 3 years, which, by the way, is the biggest single revision of the last 10 years, make that of what you will. Now that there, people are applauding it. I mean, the point Ben made is really important, which is since 2016, it is still below all the other G7 countries. You know how much I love comparing Canada to the G7. And it doesn't at all address any of the fact that we still have major structural issues around productivity, CapEx, and, in my view, massive inequality as a function of the last 10 years of policy decisions. And so, yeah, it's slightly better, or I would say it's better, but it doesn't change the overall fact that it has been a lost decade. I mean, and the gaslighting from the boomers, again, downhill towards young people to say, well, this number that we thought was shit and now is good is tells you that Trudeau was wonderful and the Liberals are great. I mean, it's kind of annoying, frankly, is the way I would say it.
Yeah, the point on inequality is really important, Rich, and I'm glad you flagged that. So, Steve, I can send you the chart. It was in a recent note, but some of the income data that's come out recently is really telling, where it shows that if you're in that kind of 25 to 34-year-old cohort, your real wage growth continues to be negative, and all of the income gains at the national level are accruing to the over 65 crowd. So even with this kind of modest uptick in or revision higher in GDP, it really does not address this kind of systemic structural issue where younger people continue to get screwed.
Ben, I was
And that
curious,
doesn't-
did you look
Go,
at
sorry, go.
the population data that came out, I think, last week for Q3? Obviously, it showed an outright contraction in population growth, which you've been all over. I think from what I recall in that data set, it actually showed immigration, basically like people leaving, Canadians leaving the country. Correct me if I'm wrong, but was it highest for basically the working class, like the prime working age cohort were basically leaving the country?
Oh, I didn't look at the age specific breakdown. I that's an interesting perspective. I have not looked at that, but in terms of just the number of permanent residents leaving the country, it was the second highest quarter on record.
Sorry, say it again.
Second highest quarter on record for permanent residents leaving the country.
Wow, permanent residents. I'm curious.
Yeah.
Was there anything on Canadian citizens? Like people that actually grew up here, lived here, and like, you know what, this country's just not what it used to be. I'm out.
That
No,
is
it doesn't
happening.
really break it down.
I mean, we see it in our business. I mean, we manage money for families that have said, "Yeah, we're out of here. We're going elsewhere." Just have a question for you. Maybe you already said it, and I just didn't hear it well. What was the main driver of the increase or the contribution to the change in GDP per capita? Is it the per capita portion, or was it inflation was revised lower, or what was it, Rich?
It was CapEx. A lot of upward revision in the CapEx numbers that contributed a lot to it. So you have in GDP in the expenditure approach, you have government consumption, which has been going up, as you guys could probably tell, investment or gross fixed capital formation. You have household consumption, and you have net exports. As I understood it, maybe I'm wrong, but as I understood it, one of the big chunks of that upward revision was from the CapEx point. One of the things that I like, just as an example, I've been really critical of the amount of money Canada spends on research and development. One of the biggest jumps that I saw in all of my charts was actually research and development spending as a percentage of GDP. We went from like a 10-year low to now trending upwards. Research and development spending is a small share of CapEx, but it just highlights the point that there was sort of a big jump all over that space. I think that's a good thing. I mean, it doesn't change the fact that we're still chronically underinvest in Canada, but overall, I think that's a good thing. But one more just thing on that, and the revisions. Those revisions were humongous, and they've been getting bigger. So it better normalize over the next couple of years, or else there's going to be real questions about the data and how authentic it is or real it is.
So will this affect Bank of Canada policy in any way? Well, they'll say, hey, we miscalculated the strength of the economy. Therefore, close your ears, Rich. I'm sorry, Steve, cover them. We need to raise rates now because the economy is too strong. Is that the deal?
So my view,
facetious, of course.
No, it's an important question to ask, because in the last meeting that Tiff Macklin actually specifically addressed that, he talked about the revisions. He said the economy was better than they thought. He said demand was stronger, but he also mentioned what I said, which is the business investment grew. And then the only thing he said was that productivity was still weak, but it did improve from 0 to 0.5, which is what I have in my chart that I've showed many, many times. The issue, I think it's one a 6 and 1.5 dozen of the other. I don't think it really changes that's my personal view. I don't think it really changes their view on interest rates or the path.
But Ben, as we segue to the sort of 2026 predictions, this year-end episode here, we talked about it earlier, but one of the sort of ongoing debates is around GDP per capita, and people are still wringing their hands about it. I think one of the ones that people are still sort of arguing online about is Canada's housing supply. You have one cohort that just says, hey, it is what it is. The market's doing its thing. And you have the other cohort, which is like government needs to intervene. We need to be building more housing. Meanwhile, you've got sort of like record, not record, but a lot of excess resale inventory, unsold new condos. Where are you at in terms of your view on housing supply? Like, are we adequately supplied today?
Well, look, you cannot have rising vacancies in the rental space, rising inventory in the resale space, and then concurrently say that you have a housing shortage, right? That doesn't fundamentally go together. So now, when you take a step back, you could make the argument that we are potentially paving the way where we will again be undersupplied in some key segments in a couple of years. but that's the cyclical nature of housing. Housing is by virtue of being highly cyclical. You go through periods where it's oversupplied and undersupplied. So you can't have an environment where prices are falling, inventory is building, rents are falling at the fastest rate on record, and then somehow say that we're undersupplied housing. That's just nonsense.
Take that back, man. Housing always goes up.
Ben, we're Canadians. We don't like economic cycles. We want the government to step in at all times to protect the incumbent and transfer wealth from the young to the old. This is the way things are done here.
Ben, walk us through your 2026. What's the one thing that sort of sticks out for you? 2026, if you're going to make like a prediction, what's sort of your, I guess?
Well, I've got two that are related. Sure, yeah, I've got two that are related. So the first relates to population growth. So you guys know in 24 I was on your show. We talked at length about what I perceived to be a dramatic slowdown in population growth that was coming. We're starting to kind of see that filter through the data. We have not seen this play out. We're still in the early innings of this population slowdown. And I think the government will be successful in engineering a decline in population on a year-over-year basis. We already saw a decline in the quarterly data in Q3. I think you'll start seeing an annual decline in 2026. And that's probably going to continue right into 2027. And associated with that, I just want to put some numbers out there, because I think the one area that the government has not gotten its hands on and kind of tightened is the asylum program, refugees in particular. And what we've seen is, while the population declined by 75,000 in Q3, the asylum claimant component was up 7,000. And here's some wild stats. So if we look at how much Canada's population has grown in the past year, we've only added about 81,000 people to the population. 75,000 of those were refugees and asylum claimants. So in other words, all of our population growth right now is coming from this one cohort. Now, there's clearly fraud in that cohort. There was a crazy article just last week where, there was an investigation to some of these. There's the Bishnoi gang out of India that's running all of these crazy, crime networks, and they were finally investigated. And the moment that Canada Border Service Agency started investigating them, they all 14 of the people that were being investigated claimed refugee status, which is just bullshit. So at some point, the government's got to start to tighten this up. I think that's going to happen in 2026. And it'll be one more thing that acts as a drag on population growth. So that's my first big prediction. I've got a related one if you'll let me, but I'll kick that over to you guys for comment.
Yes, let's banter that around then. So the biggest thing that I'm hearing from this, the anecdotal story is wild, by the way. It's just, by claiming refugee status for the guys that are going to get charged, basically. So if we go from having this, incredible population growth over a number of years to kind of flattish this year, and now you're suggesting we could go negative now in 26. Let's talk about Steve, we know the answer, of course, I think. But what does this do to the housing world and the credit world and lending and GDP growth?
Well, we'll get into that, because that's part of my forecast. Can I make one?
We can't talk about Ben's, but because it's your forecast. That's wild.
Let's not talk house prices. I won't talk about house prices. What I will say is, first off, as it relates to GDP growth, it's really easy to grow your economy when you have a 3% tailwind from massive population growth, right? It's going to be much harder to engineer nominal population growth with a zero or negative population dynamic. Engineer economic growth with a declining population. And we actually saw this. If you look at the Q3 data, final domestic demand was actually negative. It's the first decline in final domestic demand outside of COVID since the financial crisis. So this is highly unusual, and it will act as a drag on economic growth. Now, if I can just make one more point, and I'll kick it back to you guys. I think the impact on the real estate market is actually quite nuanced, because what we're seeing is the decline in the population is entirely a function of temporary residents that are leaving. You're seeing a decline in that cohort. We are continuing to add permanent residents at a pretty healthy clip. They're just being offset by a huge reduction in temporary. So the point I've been making is it's actually a weird dynamic where, in one sense, you could argue that we continue to grow the home buyer cohort while we are seeing a significant decline in the rental cohort. So in other words, that negative population growth is not as bad for the resale market, and it's way worse for the rental market than it appears, if that makes sense.
So if we have this decline in population growth, which seems to be a given, and we know this, everyone else knows this, of course, the offset to that from an economic perspective has to be leverage. Because you assume the domestic economy is still going to do the 1.25% growth, something like that. So I think you're going to see an enormous borrowing again, more deficits, even more than what we had this year. That trend will continue. Because if not, the economy, it just declines automatically. Because when you have the economy being sorted by, more and more people and more debt, you take off the more and more people, by default, you have to increase the debt.
Did you just use up your forecast?
No,
Yes.
I'm not touching. I have a better one. When you guys wouldn't even understand.
All right, well, let me
Keith, but just before we go, and that's what right now the consensus economic forecast for 2026 is about 1.1%, 1.1%.
But I bet you it's not based on this base case that we're talking about.
It's constantly moving, so it's come down, is what I'm trying to say. It is now priced in what you've described.
So let me segue on Ben's.
Well, before you do that, Steve, sorry to sidetrack you here, but because I know where you want to go with yours, can I just add one more follow-up prediction on mine? Because it is related, and then we'll kick it over to the housing side. The rental market. So I think people are underappreciating how terrible that population data is for the rental market, because we are seeing an enormous decline in temporary residents. They are the source of incremental rental demand over the last few years. And so as we look forward, we have a record number. We have 180,000 purpose-built rentals in the construction pipeline. So 180,000 rentals. We only grew the population by 80,000 in the past year. So just think about how crazy that number is. So we're going to grow the stock of rental units by almost 8% over the next couple of years into an environment of zero rental demand growth. So we are going to see, I believe, a record high in the vacancy rate for purpose-built rentals. And I think by 2027, it'll break above 5%, which we've never seen before nationally. So there's my prediction.
It's a 30-year high in Vancouver right now. In the PPR.
That's right. And listen, that's before. You guys are looking at a 16% expansion in your rental supply in across BC. These are crazy numbers. Like, I don't know how rents don't fall another 10 or 20% from here.
That's a sharp, yeah. Wow, that's a bold forecast. You have me nervous. So I'll segue on Ben's. So my sort of, I don't know, maybe it's a bit of an easy layup, but I think lower home prices, resale home prices in 2026. Particularly, I'm probably most confident in saying Vancouver, Toronto, and Calgary. Three markets that I watch fairly closely. I think those three markets are going to see lower home prices in 2026. I think the big thing is to Ben's point is, okay, so as you have, like, that rental market is correlated to the resale market, right? Which is think about how much demand we've had over the last 5, 6, 7, 8, 10 years, especially in the condo space. A lot of the demand has come from these investors, right? Mom and pop investors that, wanting to build out their portfolio. And so as you enter an environment where condo prices are no longer going up, they're declining. And by the way, your rents that you're collecting, your revenue is now declining, right? So your expenses have effectively stayed the same or have gone up, but your revenues are declining. You have a 30-year high in vacancies. Your condo now sits, when a tenant leaves, it's $200 lower, and it sits there for 2.5 months. So I think you've lost that demand on the investor side. That's not coming back in 2026. And I still think there's a lot of sellers. So in Vancouver, for example, we had a 25-year low in home sales this year. And so there was a lot of unsold inventory that has come off the market here in December that did not sell. It was unsuccessful in selling. And they will retest the market again in 2026. They will come back on in January or February, hoping for a better sort of new year spring market. And I think they're going to be in very similar conditions, which is there's just more supply than there is demand. And I think it's going to put gradual pressure on prices. So I think that's what's in store for Vancouver, Toronto, and Calgary, which has lagged those two markets, is now playing catch up. And that's kind of my forecast.
Yeah, but we can't let you off that easy, Steve. You got to give a number to it here. So if I give you an over under at 10%, are you over or under for another price decline? Because come on, man, you got to put it out there. We need a number
for annual.
Let's say annual. No, just for calendar year 26. How much will the national house price index decline?
National.
Yeah, so let's put a 10% over under.
Oh, I'm under.
Okay, 5%.
I'll say I think 5% is the right number nationally. Now again, keep in mind that like nationally from the peak they've dropped 21%, so it hasn't been like 40. You know what I mean? I just don't think the HPI is overly volatile where it's going to gap down 15%, right? Like it's I would say 5 is probably the right number. And I think like what's interesting though is on that price thing is that it's kind of just like this it's kind of the slow bleed, right? I mean, like we've been correcting for 4 years. And it's if you take 5% a year for 4 years, you're at 20%.
Yep. That math checks out.
You go 5 years, you go 6 years, and like all of a sudden you're 6 years, 30%, and then now adjust for inflation. Like it's a real price correction. So I think that's kind of the appropriate way to look at it. I would say like maybe to segue on that, and I'll wrap up my forecast, but I think marginally lower mortgage rates. I would say I have less conviction, but I think that I would add that as a prediction for 2026. I think somewhere in the mid threes, maybe, on the basis that, as Ben talked about, I think shelter CPI, which is 30% of the CPI basket. I think rents, if Ben is right, which I think he is, I think that that's going to be a huge drag on shelter CPI, and that's going to drag CPI lower, and that should help. That should help the bond market a little bit, and I think you should have cheaper borrowing rates.
So you're calling for 50 bips down from here, man. That's a bold call.
That is a bold call.
Well, your 5-year mortgage rate today is call it 4%. I mean, could it be at 3.5 by sometime in 2026? Yeah. I'll make that call, although I wouldn't say I'm 100% confident on that call.
Yeah, I was with you 2 months ago or even a month ago on that call. It's getting harder and harder to hold that conviction. But I applaud you for putting that out there. That's a bold call, Steve.
I got to make it a little bit interesting because the house price one is kind of too easy. It's a bit of a layup.
I think your hats and headgear are very bold, by the way, and it's hard to take this serious. But I think Steve's forecast so far, I think that is the boldest one. I don't know if we're going for like a bold call or anything. I take the over on the rates, by the way. I think the belly of the curve, the fire, I think it's going to scream higher. So it's going to be
Can you elaborate?
That'll go into what I forecast. Everything will go back to that.
Man, if you're right, Keith, that's going to be then for sure the price declines will be more than 5% nationally.
Yes, I would agree.
Yeah.
I think everyone agree the national price decline is not as important as your local
Of
market.
course.
Yeah, so GTA and of course Vancouver is the only one that really matters on the show here.
But like Ben, what's the GTA down this year? Like if you look at the HPI, it's like what 5%?
Oh, yeah, it's not a lot. Yeah, it's probably 5%.
It's probably underreporting
I agree with that.
the actual decline.
Yeah, I agree with that.
So, Rich, are you your prediction or forecast? Is it Canada focus or
no?
I'm global. I'm
sort of global too.
Let's do it.
Let's do paper, rock, scissors.
You go first. Age before beauty.
Okay. So I was looking at 3 different things, and I think all 3 could happen. I was thinking one thing I do expect is that oil, WTI, could hit $100 next year. That is a non-consensus call. That's not what we're discussing today. I was also going to suggest the EU could have a pretty significant restructuring, and that would have a pretty massive effect on Europe, especially with capital flows. But the one that I'm coming up with here is that I think 2026 is going to be a year where there's going to be extreme currency volatility. So basically a foreign exchange currency war. And I think that starts with Japan. So this is based on my premise that the Bank of Japan, they already announced it implicitly, but they're going to save the bond market and let the yen depreciate. So right now, where's the yen? Around 155-ish, 4.6, like in that range. So let's say we have a target of 200. It's about a 25% decline on yen. And then we look at the effects on that globally. So you start with Asia, and then you work your way out. From a trade perspective, so if the yen depreciates 20-25%, all of a sudden now you have a trade war. So they've made for example, and Rick, you brought this up with Europe before. Japan is making the decision to do an external devaluation. So they're going to try to improve their economy, having a very cheap currency so they can export stuff. And who's the main trade competitors? They don't all make the same things, but basically you're looking at China, Taiwan, and Korea. And if you follow the Korean currency recently, it is under pressure significantly. But with Japan doing that, it's then going to create pressure from those guys to devalue as well. The problem with China is that they can't do an external devaluation because the currency is pegged. So they have to do an internal one, which means they have to suppress, wages, employment, and things like that, try to keep domestic costs down. And that ain't going to fly. That is not a good move in China. So you can see them to start actually weaken the peg next year. And as all this is happening, who's going to lose their shit?
U.S.
Yeah, but so
China.
even more.
China.
We already said China. No more guessing. It's going to be Europe. Europe is going to lose it, especially Germany, because they can't compete anyway right now on price. So I think you're going to see a whole. So again, this is based on the view that you'll see a gradual depreciation in yen, not like a sudden jolt. Because they've been doing this now for 40 years. Like they're very good at doing yield curve control, managing their balance sheet with QE and all that. So if they're able to continue gradually, and they will intervene in the currency market if they have to, because they don't want to slow leak with it. But this is going to have a cause and effect of causing other central banks, including the Fed and the Bank of Canada, they might have to cut rates as well. If CAD gets too strong, relative to someone else, who see the Bank of Canada stepping in, but it's going to potentially create this. It's a higher probability of Asia. So you go back to the late 90s when they had a currency crisis there. And, that then will just sort of swamp the world economically. So back to the question about the yield curve and the 5-year rate, I think it create a lot of uncertainty for economic growth. And banks are going to be very reluctant to take on low risk. They'll have credit spreads rising. Questions? The guy with the funny antlers. That's you, Ben.
Well, yeah. No, that's fascinating. I like the way your mind thinks about this. Can I ask a question from a kind of a portfolio structure perspective, if you're allowed to talk about it? Like, how are you thinking about this? If you view that as a risk, like what sort of things do you do to kind of mitigate exposure for client portfolios? Or are you not allowed to discuss that stuff?
No, but you can do, yeah. Talk about it in general. Yeah,
I'd love
absolutely. Yeah, I mean, so first of all, with increased volatility, it's going to create wider movements. If you look at equities, for example, like you can easily see equities minus 20 and then plus 30, plus 40. You're going to see these kind of movements. On the currency side, it won't be that extreme, but you could easily see, for example, if the yen does go down 25%, that gradual move, you can easily see every other currency, doing plus or minus 5% with moves. And the trick, of course, is that nothing breaks as this is happening. But from a portfolio perspective, again, I do think there's going to be adjustment in risk assets, but gold can fly again. But you could have an initial sell-off first. So you have to look at it again. Like, why is gold doing so well this year? Because it knows something is happening. It's not really the housing market that's driving it. It would be, the credit behind a housing market or global conflict and things like that. But gold is telling us that, something significant or more significant will happen in this coming year. So you don't want to go all in on any one market, Ben. You want to be spread out across probably 5 different markets that we look at. So then when you do get these breaks or cracks in a market, then you can really go in and take advantage of it. But I think anyone that's just not assuming this is a risk next year, I think you're just really missing a potential. This is an easy one, guys, because again, the banquet man was very clear with it.
Yeah, I love that you guys don't run like your standard boring kind of boomer 60-40 portfolio, that you guys are willing to give thought and really manage risk thoughtfully around some of the perceived issues out there. I respect that you guys aren't just kind of like index huggers, just earning your fee, but you're being thoughtful around risk management. Yeah,
even with these silly hats on, we can be thoughtful. Rich, what are you thinking with that scenario? What
I think your premise is actually sort of what I've sort of built mine on, which is could be good, could be bad. Which is if the yen does continue to come under pressure, I think you'll see a continued weakness out of Germany. Now, Germany is under a lot of pressure, partly because of climate self-harm, climate economic self-harm, partly because of the rise of Chinese industrial complex around cars, specifically EVs. And then, of course, because of the increased energy prices related to the war in Russia. And I think what you'll see if there's continued weakness in Germany, which is the most important economy in Europe, keep in mind that employment in Germany has been flat for almost 3 full calendar years. I think we're just under minus a couple of months, which is really incredible. They're 26 or 27% of Euro area GDP. So basically, in short, I think we'll see the continued rise of right-wing populism in Europe. And the reason that's really important to me is because of the knock-on effects with respect to obviously immigration, but clearly in terms of climate policy and energy policy around that. I think a couple of days ago, we saw they got kiboshed the EV mandates out of the EU. They're starting to flirt with that idea. I think that will accelerate. They've relabeled nuclear power as green energy. They're going to relabel natural gas as a transition energy. I think those things are all sort of going to fall into place. And the reason they'll need to do that is because of the weakness economically, and the powers that be will want to fight back against this rise in right-wing populism. What's really important is people understand that the power has just fundamentally shifted. Marine Le Pen is going to not be allowed to be run. That's a French presidential candidate. She won't be allowed to run. Her number 2 is just as popular because people know the game. You're having the rise of the Reform Party in the UK. I know that's not technically the EU, but it's important. You've already have Italy with Meloni, who's actually doing relatively well economically. You've got Spain, which is right now a left-wing party, but I think they're shifting. And then the last one is the AfD for Germany, which continues to just have an incredible amount of momentum politically. And that's going to put an incredible amount of pressure on all of these things that we took for granted from an economic standpoint, which is immigration, climate policy, and et cetera. And so that to me is really, really important. And that the reason I think is really interesting is because that correlates with what I think is the fall of right-wing populism in the United States. And so why do I say that is because that's critical for policy in mostly 2027, but it'll start in 2026. Remember, you have a K-shaped recovery. Consumer sentiment in the United States just hit another low. You've got the yield curve inversion, which has predicted 9 of the last 6 recessions. I think that's really, really important. That was a joke, fellas. But that leads up into a situation where you're going to have midterms in 2026, November. And that US gridlock is critical for passing budgets, direction of spending, et cetera, et cetera. And so that shift, right-wing populism in Europe taking control of economic policy, and the fall of right-wing populism in the United States taking control of economic policy. And to me, that's the most interesting thing.
Is that, I don't know what you just said actually. So is that a forecast or is that?
Yeah, it is. That's to me, that's what I think is happening. And the reason that's important is because if you think about energy policy, to me, that affects climate policy, which has dominated the conversation for years and years and years. I think we're going to see the end of that. It impacts immigration policy, which again has lifted economic growth sort of artificially across Europe, Australia, Canada, and the West. And in the U.S., I think U.S. gridlock is really, really bad for growth. And the yield curve, I think, is sniffing all of that out.
Keith, just to riff on your $100 WTI call, I'm assuming there would have to be increased global conflict to get there. Is that part of your view?
Yeah, absolutely. You have that happening, and then like it's interesting. So one thing, like with financial markets, you always have to look at what does everyone love right now, and what does everyone hate. So everyone hates oil. I mean, if you look at if you look at the numbers, the way they're crunching right now for, if you look at the forward curve, you could make an argument oil should be at zero again. Remember, it hit negative. Was it back in 2019?
No, 2020.
Pandemic, 2020.
2020. Yeah. Yeah, it was too much. It was
negative $20 a barrel, Keith.
Yeah, I remember in the futures market those days. Like most desks just would not take any trades whatsoever because no one wanted to take delivery of oil because you had nowhere to put it, and no one wanted it. It was just a really weird thing. But you could make an argument, Steve, that the bottom is in with WTI, so West Texas Intermediary, maybe it's $50, 52, we don't know, but nobody wants to buy oil right now. That's the theme with it. So when something gets washed out that bad, you could automatically have, a 20-25%, jump on that. And then what's interesting, if you look at Saudi Arabia, for example, their budget that just came out recently, they're running huge deficits, and I forget the exact number of their deficit, but if you back out the numbers, they're using a 102 oil price,
Jesus,
not 57. So the Saudi economy just completely implodes. I shouldn't say implode. Their debt will explode if oil stays at this level. So there's a lot of moving parts with oil. But if the economy if the global economy becomes more difficult, if you get the currency wars taking place, for example, trade wars, sort of the left to right and right to left swing, with this, this pendulum that Rich was just sharing, it can create the potential for just the cost of shipping this stuff around just goes higher. So, in the investment world, you want to find something that no one likes, and then, you really are buying low.
Keith, how do you square just weaker growth more generally? As you've talked about at length, we're grinding lower, whether it's US, whether it's Europe, Japan, certainly. How do you just square weaker global growth, which ultimately means weaker oil demand, with higher prices? Oil?
I think I think the thinking is going to shift, because remember the Americans, they changed the view on globalization when Trump came in. Was it last year? I think it was early this year. Their policy is now domestic, nationalism. We are looking after us first. And, the whole world went nuts because, hey, we've signed up for globalization. That's what we want. Everyone wants. However, that's now changing. So for some markets, you can see oil being not as expensive, but China, for example, Japan, they need energy, Europe and so forth. So I think it becomes more of a local play. And then that creates, this potential for global conflict. I don't think we can look at the world the same way that we've used to, that we become accustomed to, because, the Americans have completely changed on how that's going to be viewed.
I mean, the other angle is,
they're basically, embargoing Venezuela. And you get the drug story, of course, with it and everything. But there's a lot of big things happening. So the other theme with this as well, if you think about it, the beginning of 2025, there was some volatility because it was when the whole tariff story first broke, and every day it was a bit chaotic out there. But really, over the last 9 months or so, nothing has really gone wrong in the world. Like no financial market became broken or anything like that. And the expectation for that to continue next year, it's not as high. And maybe it gets pushed out into 27. I don't know. But you're getting this increased unhappiness with everyone, whether it's from an economic, political, socially, from a domestic perspective, even here in Canada. Things are just set up for something to just sort of go off sides here. And I think it's going to be led with the currency world.
There's one more thing on the oil thing, which just to remind our viewers of what Heather Exner-Perot said, which is that the Permian Basin is starting to sort of dry up. Again, this is at the margin. It's becoming more and more expensive and less productive. And then just the chronic underinvestment in that space. I mean, we all know what happened in Canada. Basically, all exploration and production capex basically was vaporized. That's happened globally because of this whole climate policy stuff. And so that's still that lags, obviously, but has meaningful impacts going forward on oil prices. Or if there's a shock, there will be not enough supply to absorb it.
Okay, do you want to do any more financial economic stuff? We're here, Steve's hockey prediction for the upcoming year.
Well, I'll just chime in real quick. I think, Keith, if oil screams to 100, I mean, it's hard to overstate how negative that is for some of the growth-heavy assets like the NASDAQ. It's just, you got companies in there trading at 50 times sales right now, some of these big AI plays. If oil's at 100, man, that's a bad scenario.
So that was one of my other.
Well, it's only bad if you don't hold oil. If you hold it, it's actually
right. Or if you're long NASDAQ and you don't have oil, it's bad. Yeah.
Well, that was one of my other forecasts, which is not forecast, but I was trying to avoid stating the very obvious, which is that this that the AI sort of I'm trying to think of a more polite way. Anyways, the AI bubble sort of
the circle. Steve Martin. Is that the way to say it?
I was trying not to say it, Keith. But yeah, the sort of all of this incestuous investment, let's just say that incestuous investment sort of is exposed because if the productivity gains that these companies are sort of touting just don't happen because these language models just don't sort of come through, or the other side is that the energy cost just becomes super, super expensive. I think that's something else we should talk about with respect to oil. I mean, for the first time in 25 years, energy consumption is rising basically everywhere. And you're seeing even the price of Henry Hub natural gas in the United States is now approaching the European TTF, which is sort of the market out of the Netherlands, which is incredible. And so that will also really be interesting. If it's too expensive to operate these AI farms and they just don't deliver on the promises that they're making, as Ben mentioned, they're extremely expensive and they could correct.
And that's where the conflict comes in. I mean, Bill Gates made that huge pivot. Remember?
Yeah.
I mean, and as you say, you need energy for this. Again, I just think next year is set up for some really volatile events, and it's going to be chaotic in the beginning. But once, people go back and they, re-listen and re-watch the Loonie Hour episode 220, then they're going to realize, man, the four babbling turds were right.
I guess I wasn't clear. That's why the gridlock in America is just so important, because right now you have the House, you have the Senate, and you have the president, all Republican. And the truth is the election cycle is going to start in November, which means 2 months before that, nothing is going to get passed. And then you're going to have, listen, Mamdani, who is a self-proclaimed socialist, was elected in a landslide for New York City, the epicenter of global hedge funds and capital market. And I think that, if the K-shaped recovery is real, if you have a weakness in the housing market, that's going to affect the ability for Republicans to do well in those elections. And if there is a real gridlock in next year at roughly this time, I think you'll start to see it in capital markets. This is not a new idea. This has happened sort of time immemorial. And it just adds to the potential for volatility, in my view.
Well, anyway. I think that's a good place to wrap it up. And there's lots to look forward to here in 2026. Obviously want to wish all of our listeners Merry Christmas, Happy Holidays, and thank you so much for all the support throughout the year. And Ben, obviously appreciate you coming on the show. It's always insightful to have you on.
Yeah, thanks. Merry Christmas, guys. And if I can say something, Keith and Rich, just as a client of IceCap Management, just congratulations again on another great year. And I just so appreciate what you guys are doing for your clients and for my family as well. So Merry Christmas to all three of you guys, and a special thanks to you boys.
That's great. Thank you, Ben. Merry Christmas, everyone.
See you next year.
Happy holidays.